so much for joining us on this Saturday morning. Just a quick standard disclaimer before starting the session that the stock ideas that we'll be discussing in this session are just for the educational purpose and it has nothing to do with the investment advice. So do consult your own research, consult your investment advisor, or do your own research before taking the stocks in the portfolio. So without further ado, just start with the presentation. So if you can just move to the next slide, I'll just quickly take you through the agenda for the day, like what topics we are going to cover. So mainly we'll starting with the category comparison, like how the different market caps have behaved in the past, and then I'll be taking you through some of the rationales why mid caps seem the best position for the future growth, and then I'll also be taking you through some of the economical tailwinds which are present present there in the market, and which will propel the mid caps to the new highs in coming decade. And then my colleague Vijay will also be taking you through the internal multivariate framework that we follow in-house. And he'll be taking you through some of the case studies and the performance update, right? So starting with the category comparison. So if you can just move to the next slide. Yeah. So what we have done, we have compared the performance across different time period for all the other indices, right? So mainly if you look at the comparison of the performance for the Nifty 100, Nifty Mid Cap 150, Small Cap 250, and Nifty 500 over longer time horizon, right? 5-year, 7-year, 10-year, and 15-year time frame. So mainly what we have seen that this mid-cap space is the best position, right? So just ignore the 1-year and 3-year period because this is the period where a lot of volatility is there, and the returns are getting impacted by the short-term volatility in the market. But if you focus on the longer horizon return, which is the 5-year, 7-year, 10-year returns, so we can see that the mid-cap index has comfortably given outperformance of 3 to 4% over the large cap index as well as the small cap index, right? So mainly for those who are not sure like how this index is created, so mainly when we arrange all the market caps as in the descending order, so the top 100 companies in the market caps are the large caps, then the next 150 companies are the mid caps, and then the last 250 companies are the small cap. If you go by the AMFI's criteria of categorization across different market caps. So if we take the entire universe and take the market cap, so the top 85 percentile of the market cap is the large cap. Next 10 percentile from 85 to 95 percentile is the mid cap, and the last 5 percentile, like 95 to 100 percentile companies in terms of market cap are the small cap companies, right? So what we take away from this slide is that if somebody is looking to invest for a longer time horizon and he doesn't want to take active risk in the market, right? He doesn't want to actively manage his portfolio. So the mid cap index is again a very good option for that investor to park the money for, let's say, 5 to 10-year time frame, which can easily compound and give alpha of 2 to 3% over the other indices, which frankly what the most of the money managers in the market also try to achieve, right? So if we can just move to the next slide. So mainly the reason why the mid caps and some bit of small caps also are is a space where we can have a lot of investment opportunity, mainly because all the leaders like be it IT, finance, pharma, or old age economy stocks like metals and cement. So all these leaders are there in the part of the large cap space, which is Nifty. But if you look at some of the emerging themes, which are growing at a very rapid pace, be it the EV ancillary side or the retail side or something like structural tube segment, right? So these are the businesses which are very niche. The market size itself is anywhere between 50,000 crore to 1 lakh crore, right? So the market is not big enough, but these companies in this segment have a very good growth track record, right? And the expectation is that as in when the disposable income in the hand of consumers will increase, so these segments will keep on growing at a very rapid pace. Plus, it's a very diversified segment, right? So if you focus on the large caps, so it's a very crowded segment with most of the companies commanding, or the most of the sectors commanding, let's say 50 to 60% weightage. But if you talk about mid caps especially, or the large small cap space also, so it's a very diversified segment. So we have a lot of new themes, new ideas, new sectors there to invest, and obviously a whole lot of more companies there, right? And again, since this company is slightly lower in the market cap size, so and some of the companies are not very good in disclosure, so analysts don't have a lot of coverage on the stocks from the mid and small cap side. So that's why they trade generally at a at a premium which is at discount to the large cap peers, right? So we have two things. We have a very wide diversified base. We have companies which are growing at a very rapid pace, since the entire segment is coming out in a very big way. And also the valuation comfort is there, right? So that's why this entire segment of mid and small cap is best positioned to create wealth. Now, in the forthcoming slides, we will look for, like, the reasons why mid cap is our pick over the small caps or for the large caps for the wealth creation in the future years. So if you can just focus on dividing this segment across three main categories. So the large cap we have internally placed at, like, all the companies which have a market cap of more than 30,000 crore are placed in the large cap bucket. All the companies which have a market cap of less than 5,000 crore are put in the small cap bucket. And the companies between those two, right, between 5,000 crore to 30,000 crore market cap are placed in the mid cap bucket, right? So what's happening here is that, like, the large cap companies are companies which are growing at a, like, low teen to mid teen pace, right? The earnings are growing at low teen to mid teens, between 10 to 15% kind of compounding they are doing. And most of the growth that has already been done in the past, right? So the future growth rate is very on the lower side of it, right? And again, these are kind of well-discovered companies, so the valuation is quite high in this segment, right? If we compare that to the small cap space, so we have a lot of companies, right, upcoming companies, but since, like, it's a very wide universe of 1,300 stocks, roughly, right? So the chances of finding out the stock which can which will not perform in the future is also very high in this segment, right? So the failure rate is quite high in this segment. That's why, like, it's only for the professionals and active investors to get into. But if you compare that with the mid cap space, right, so here we have the valuation comfort. Here we have the companies which can continue to grow in the forthcoming years at a very good pace, right? And again, like, there are only around 200 to 300 odd companies in the segment. So this is a segment where we can easily look into and do a deep dive into and find out the companies which can give the multi-bagger opportunity to us, right? So that's why we have we have positioned such that, like, the mid caps is the best performing of the three sub asset classes that we have. Now, in the forthcoming slide, we'll just look at, like, if we compare the calendar year performance across the large caps, mid caps, and small caps, so how they ranked us. So if we compare the performance of the large cap on a calendar year basis versus mid caps and small caps, so what we have seen, the small caps is the segment where a huge volatility is there, both in the upside and the downside. That's why we'll see the blue ticks as well as the orange ticks happening most in the small cap space, right? Large caps only outperform when there is a market is kind of volatile, or the market is kind of in a correction phase, right? It's going down. So that's the only time period when the large cap outperforms the other two categories. But the interesting part and the takeaway from this slide is that the mid cap, although it has given very few years where it is outperforming both the large caps and the small caps, but the noticeable part is that in the last 15 years, it has never given a year in which it was underperforming its peers, right? Both the peers, large caps and the small caps. So it was never the worst performer in the last 15 years versus the large caps and small caps. And that's the reason why, like, it's growing at a very average rate, like, always growing lesser than the small cap and falling lesser than the small cap also. So that's why the growth has compounded over the years. And now if you look at the CAGR performance of this mid cap segment, so it is 13% currently versus, like, the long-term CAGR of 10% for the both the large caps and the small caps. So that's a key takeaway that, like, if somebody is targeting very moderate return over longer time horizon with lower volatility, so the mid cap is the space to be for that investor, right? If you can just move to the next slide. And also, a lot of times our investors ask that, what could be the good segment to double the money in, like, let's say, a time horizon of 5 years, right? So we have done this research where we have looked at data point of last 17 years, and we have taken out the 10-year rolling CAGR returns. So if you compare the rolling CAGR returns of 10 years and see the segment where the mid caps and the large cap index has given a CAGR return of 15%, more than 15% over 10-year time horizon. So 30% of the time mid caps has given a return more than 15%. And it's noticeable that when you compound the money at more than 50% CAGR, so the money will be, let's say you have invested 50 lakhs into the market, that will roughly be 2 CR at the end of 10 years, right? So this segment again, mid cap is one of the segment where you can just comfortably grow your wealth at a very healthy pace versus the other large cap space. The volatility is quite high in the small cap space. That's why we have not taken that into account, right? So, and also if you look at the growth rate between 10 to 15%, so there is an instance that 56% of the times the mid cap has grown the wealth more than 10 between 10 to 15%, and the number is again lower for the Nifty, which is 44%. So if you can just move to the next slide, please, Prabhu. Yeah. So the reason why, the mid caps behave in a more symmetric way and more balanced way, because like the index is quite diversified and well balanced, right? If you look at the top holding of the large cap index, which is around 15%, compare that to the top holding for like last several years from the mid cap space. So that's roughly around 2.5%, right? And again, the weights of the entire 100% weight is quite evenly distributed in the 150 odd companies, right? So the volatility, even if there is volatility in the market, it's quite easily absorbed by the mid cap index. And that's the reason we have very few years where the index is given the biggest drawdown in the past. So if you look at the sectors, which compromises of all the stocks which are out there, so like roughly 60% of the weightage goes to the sectors like finance, IT, and energy for the large cap space, and which is again a very crowded segment, and segment where we have a lot of concentration and skewness of weights there. But if you compare to the mid cap, so it has a lot of upcoming sectors and a lot of sectors which are growing at a very healthy pace. Like take example of entertainment, or like take example of travel, then take example of capital goods space, which is again a key beneficiary of the growth in the economy. So all the sectors have a very healthy representation, right, in the mid cap index. So that's again one of the reasons why this index is behaving in a slightly more balanced manner than the other two indices. So if you can just move to the next slide, Prabhu. So now we'll look at some of the key themes that will be propelling the mid cap index to the further highs, right? So what we have done, we have looked at the past, we have looked at the how the things have moved in the developed economy, right? So currently we are $2,000 to 2,400 per capita GDP economy, right? So mainly when the market moves or the economy moves from let's say 3,000 to 5,000 or 8,500 per capita GDP economy. So there are certain things that certain segments in the economy which gets a push mainly because of the rising disposable income in the hands of the citizens. Right. So there are segments like real estate or credit or retail, which will get a boost, and we'll see increased penetration up to 60 to 80% when we'll approach a threshold level of $3,000. Similarly, when we approach a threshold level of $5,000, so we'll see increased penetration of mobility in the economy. And when we move to the threshold of, let's say, in 10 years, $8,500 economy, per capita GDP economy, so we'll see the increased penetration of white goods space. For example, current penetration of white goods space in the economy is roughly 20%. If you compare that with that number with the developed market, so that number is close to 80%, right? So we'll see the increased penetration of white goods space, white goods companies in the economy. Also, there will be increased segments like recreation and then mobility, electronics. So all those segments will come and grow going forward, as when we'll be moving ahead in the per capita GDP in the going forward years, right? The other thing to notice is that the mid cap space is closely linked with the overall market, right? So how the GDP behaves has a very strong impact on how the mid cap index behaves. So in the next slide, we'll look at that. So if you can just Prabhu, move to the next slide. Yeah. So if you can just look at the years like 2010 or 2018 or 2022 also, right? When the economy was going very good, so the returns from the mid caps was also very high, right? So I'll just put a thing to put into perspective. So if you look at the last 10 years, real GDP growth rate, it was around 5.5%. If you look at the inflation rate, it was again 5.5% for the last decade. So the nominal GDP growth rate for the economy was somewhere around 11-12%, 10.5 to 12% on a rough basis. If you compare that with the Nifty return of last 10 years, so the Nifty has grown by 13%. So on a base of 11% on an average GDP growth, the Nifty has grown by 13%, and the mid cap index has grown by around 18%, right? Now compare what we are forecasting for next 10 years is that the real GDP growth rate will be somewhere around 7.5%. Inflation, let's take on an average between RBS threshold of 4 to 6%. Let's take an average inflation rate of 5%. So what we are seeing is that the next decade, the India is going to clock 12 to 13% kind of growth on a nominal basis, right? So what we're expecting the mid cap segment to be that it will grow in higher teens in this coming decade, right? So that's the reason why we are again so much bullish on this specific segment, and we have a lot of stories, upcoming ideas that we'll be sharing in the forthcoming slide. So Prabhu, if you can just move to the next slide, please. Yeah. So there are some key market leaders that we are all we all know about some of the themes like IT and pharma and FMCG, the giants present in the large cap space. But there are certain hidden stories which are the market leaders from the mid cap space also. So, for example, we are holding a structural steel company in the portfolio, which is the largest structural steel manufacturer company in India, and it has a market share of 60%, but it still continues to double the revenue every 3 years, mainly because it is able to create the new markets. Then we are also, since there is a lot of infra spending happening in the economy, a lot of building materials are getting consumed, right? So we are holding a wires and cables companies in the portfolio, which is again going to grow at a very good pace, doubling the revenue every 3 to 4 year time frame. Then, since there is a lot of EV push and the EV sector itself is going to grow at 45% CAGR over next 10 years. So the largest EV ancillary, which has an order book, again, very robust order book present in the portfolio. So mainly this is again one of the stories that we are holding. Then the largest fashion retailer and the largest micro NBFC, right? MFI, NBFC. So these are all the companies which are part of the mid cap index, right? And that that has a good growth prospect in the coming years. So I'll now ask my colleague Vijay to take you through the multi-bagger framework and some of the case studies to take you through how we approach to this opportunity of creating wealth. Yeah, Vijay.
Yeah. Thank you, Prabha. So now we have a better understanding that which industries are going to benefit because of the economic shift that is going to happen for the next decade. Now we will try to analyze that which are the businesses that we want to bet in. So what we have done is we have built up a solid framework around picking up the businesses which have potential to generate higher net worth for the investors and overall at an industry level as well. So basically our framework revolves around two basic parameters. So first one is the growth, second is the value. So if we focus on the first parameter, so what we essentially look for is the business which can double its profit in next 4 to 5 years, or let's say 3 to 5 years horizon, depending upon the type of sector and depending upon the industry from where we're looking at. And second thing that we look at is the valuation. So the valuation of a particular business should be reasonable. And of course, it should be less than the industry, and also it should be less than the industry leader. So which gives us a little bit margin of safety. So let's say if the earnings are going to double in the next 4 years and stock prices are just slave to the earnings growth, so we can safely assume that we will have approximately 2x stock price performance coming from the PAT growth side. And if the valuation is increasing, because once the street starts to recognize the potential of the company, people will start buying the stake at a higher premium as well. And it will also lead to substantial re-rating into the price to earnings or EV by EBITDA multiple. So if we think that the valuation will also grow by 2x in the next 4 or 5 years, so we will get 2 into 2 approximate 4x kind of stock price returns from a particular business. And that is how we get a multi-bagger returns. So we should also always keep in mind that the stock price returns are nothing just but the reflection of the underlying company's profit growth and how the company is building its block by block on the corporate governance side or the business fundamental side. So this is our framework that we apply across different industries and which help us to understand that which companies have higher potential to build industry. Prabhu, if you can move to the next slide, please. Yeah. So to just go a little bit deeper so that we have better understanding that how we are doing the actual business analysis. So our framework is basically revolves around the growth at reasonable valuation philosophy. And whenever we are picking a particular business, we will have very in-depth analysis. So to just give you a quick highlight, so one of the specialty chemical company which we onboarded somewhere in 2019, Neogen Chemicals, which is again just for a education purpose, not a recommendation. So when we were studying this specialty chemical value chain, so it involves a lot of technical understanding and academic expertise. So we collaborated with one of the IIT in India, and we engaged with one of the professor, which helped us to understand the value chain of the specialty chemical for the Neogen. And it not only helped us to get the sources of moat, but also the durability of the moat. And basically, the moat is a competitive advantage which helps business to govern, or let's say the carry out higher earnings multiple, and also the above average profit for a longer period of time, so that the free cash flow or the profit that company generates can remain stable over the next 10, 12 years period of time. And it also increases the valuation multiple. So we got a very healthy understanding of the Neogen Chemicals moat, and also we understood from the management that how they are going to double their revenue in next 3 to 4 years of time. And we onboarded the stock in somewhere around 2019 at around 1x forward P of 15x. And when we are picking any business, so we have also a very clear exit in mind. So we set valuation guardrails. So in particularly in the case of Neogen, we started the business stock picking around 1x forward of 15x PE. And once we had kept in mind that once the business hits 50x PE, we will start exiting the business incrementally. Also looking at the incremental growth, which will still remain ahead of us. So right now the stock has almost 3x in our own portfolios across our various strategies, but we have also sufficiently trimmed down its exposure. So now it is still in our portfolio, but not at a bigger position in our across the various portfolio. So these are the guardrails which help us to trim the profit, and also help us to do the position sizing across the different businesses. So in summary, what we are trying to do using this framework is we are trying to pick mainly the mid cap and some bit of small cap businesses which have higher growth potentials, which have higher competitive advantages, and the durability of those competitive advantages is very high. And those segments that or those businesses which we are looking are basically less institutionally owned. So when the institutional recognize the potential, like mutual funds or the bigger fund houses, they will start increasing the stake in those areas. So the valuation will have upside, which offers us margin of safety. So that is what we are trying to do using this framework. Now I will quickly take you through a couple of case studies so that we have better understanding that how we are applying this framework and how we were able to get the some of the multi-bagger businesses which are still present in our portfolio. So one of the company is again from the wires and cable sector, which Prabhat earlier discussed and mentioned. So it company's name is Krishna Electricals, which is the KI Industries Limited, which is one of the emerging leader in wires and cable segment. So the company is present across various wires and cable segment in terms of institutional side, business, retail business side, and also on the EPC side. So when we were studying this company in 2019, what we found was basically the company was struggling with the working capital because its EPC business, basically the order execution business, had a very high working capital, and they had a very high account receivables. Because of that, their return on capital employed had deteriorated during that time, and we thought that there is a good opportunity because the management had realized its mistake, and now they were raising the fresh QIP to propel the business from institutional and EPC business to more of a retail business. So whenever one business is trying to build a retail business through dealers and distributors, so automatically working capital requirement goes down, and it also improves your return on capital employed ratio. It also increases your EBITDA margin, and also it makes you puts you in a position to charge higher premium versus an institutional business. So we saw the emerging opportunity which was coming in terms of KEI. Then we also carried out a local survey in Western market of India, where we understood from the various industry participants that KEI had been very aggressive. They had hired more than 100 salespeople in a single year to propel the business of B2C, basically to push more into B2C side, which helped them to grow their revenue at a quickly speed. Simultaneously, they kept cutting down their EPC business, which helped them to gain more EBITDA margin and brought more stability into the business. So eventually, Street also started to recognize. So when we onboarded the business, it was somewhere around 15 XP on 1 year forward. Now it is trading around 30 XP on 1 year forward basis, and it had very fantastically outperformed Nifty if we compare, as we have captured in the chart of in the last 5 years region. So it has almost gone up by 4.5x versus Nifty has just gone up by 1.7x. So this is one of the case study which we like to highlight a lot to our industry participants, because it's also story of failure somewhere around 2018 2019 time, but management realized its mistake, and they had a very solid corporate governance framework which helped us to correct their mistakes in very short period of time, and eventually they improved the business operations to a lot, and now they are the second highest leader in terms of wires and cables industry. So that is a one good example that we can always benefit from studying a particular business. Now we will move on to the second example. Yeah. So second example is coming from a structural tube segment. Again, APL Apollo tubes, a lot of investors are familiar with because of the recent run up in the stock price and also the solid performance in the revenue and profit growth. But when we were studying this business around 2019, 2020's time, during the COVID time as well. So what we found was the whole industry of structural tubes had a high working capital, relatively higher working capital if we compare with the other consumer segments which are doing business through dealers and distributors. It had around 28 days of working capital, and because of COVID, there was a lot of loss on the account receivable side. So the APL Apollo had thought very revolutionary thinking, and what they did was they shifted their entire business from credit based sales to the cash and carry based model. So they started giving additional discounts to the distributors if they buy and pay on time, or let's say they are buying in the cash format. So now if we look at the working capital days, it has come down from 28 days to mere 7 days as of now, and the company has improved its return on capital employed, its EBITDA margin in the last couple of years, and it had fantastically outperformed the majority of its peers in the structural tube segment, and now it has become the almost undisputed leader in the structural tube segment. And if we look at the future, so now they have around capacity of 2.6 million ton, and now they are building up a second capacity which is a 1.5 million ton in Raipur. So essentially the company is targeting to increase its volume by 30% per annual basis for the next 3 years. So if we look at the revenue and the profit growth, so it should handsomely double in the next 3 to 4 years time. And management has done a phenomenal work in terms of Raipur plant expansion. And we are expecting the plant will come alive on the Q3 of this financial year FY23. So we will have somewhere around better quarters going ahead, and there will be a incrementally higher upside on revenue and profit. So that is also a business that we liked a lot, and we had gone ups and downs with the business, but it had done well for our investors and broad base on the industry level as well. Yeah. So yeah, please move to the next slide. Yeah. So lastly, the efforts that we have put in terms of studying the industry, studying the businesses, onboarding those businesses, and going ups and down with the journey of the business as business grows from expansion to the contraction. So one of the strategy that in the mid cap side, our internal strategy is RH Super Value. So the strategy has been around for more than 9 years in the market, but we recently rejigged the strategy a couple of years back in somewhere around 2020, and we completely revamped the portfolio. And if we look at the recent performance on one of the external coverage, so Super Value has been a best performer in 5-year category. And if we look at the last 2 years performance since the rejig and the new fund management which took over, so it had handsomely outperformed the index. But we also are cognizant of the fact that the performance of the particular portfolio, the performance of the businesses are not symmetrical as we are comparing with the fixed debt income securities. So we also need to keep in the mind that journey of stock market is not going to be easy. It will have its ups and downs, especially if we are thinking from a broad point of view of, let's say, the 5-year journey. So in couple of years, there will be always ups and downs. Like this has been a mostly the flat year for most of the industry participants and most of the businesses at the overall level as well, which were kind of flat since the Ukraine war has grapple the market with lots of worry, and also the US Fed, which has been very aggressive in terms of controlling the inflation. So we have seen a very flat year, and there was mostly the bear market kind of performance across the global economies and global stock market as well. But when we look at it from a long-term point of view, the stock market journey will have always phenomenal rewards. The person or the investors who are willing to wait and choose the right businesses in terms of fundamentals and the better valuation multiples. So I hope we have done justice to your time, and that will be us from our side, and we can maybe open up for the Q&A. Yeah, thank you everyone, and thank you for the attending this. So Prabhu, over to you now. Yeah.
Thank you, sir. So the question is, which sectors are you positive on?
Yeah. Yeah, so it's a good question. So of course, we had seen a lot of turmoil in terms of last 9 months, basically last 3 quarters, where most of the industries had faced the margin pressures. But what we like in terms of some of the sectors which have remained the survivors, like particularly the retail side or the consumption side, we like a lot. The retail sector we are quite bullish on. Another sector that we liked is a banking side, which had seen a phenomenal credit growth in the last 12 months, year-over-year basis in double digit. And the valuations are very reasonable because the sector has been out of flavor for almost like last 2 or 3 years. And we had not seen any major re-rating across the particular businesses. And the growth prospects are also very good. If we look at the NPAs of particularly the balance sheet on the large private banks, or let's say if we are talking about the mid-sized private banks, so they have cleaned up a lot. Their capital adequacy ratios are very good, which gives us a very strong convincing evidence that they can absorb the further losses in case if they incur. But most of the corporate balance sheets are clean, so we like a banking from that point a lot. Of course, we like building materials as well, which have like a wires and cables segment we like. One of the segment from building materials, again, PVC pipes that we like. So these are like 3 or 4 sectors which are favorable in terms of our own thinking and understanding. Yeah.
Yeah, thank you, sir. So the next question is, the success ratio for small caps to move to Nifty is less than 10%. So how do you manage that risk?
Yeah. So Prabhu, can you please repeat the question?
Yes, sir. So the success ratio for small caps to move towards Nifty is less than 10%. Now, how do you manage that risk?
Yeah. So that is a very rational question. Okay. So it requires a little bit of like taking a step back in terms of like how the businesses move from small cap to mid cap, starting its journey from, let's say, the micro cap company if it's listed on the index. So it will move from micro cap to small cap, then mid cap, and eventually large cap side. So when we are interacting with a particular business, so what we try to essentially look is we first study the industry, and we try to understand whether the industry has certain characteristics like high profit margin, high EBITDA margin, and high return on capital employed. So if we look at some of the industries which are grappling with the low ROE, low ROC number, high debt to equity, so we normally avoid this kind of industry. One of the example can be the real estate, which has a very high debt to equity ratio and a lot of working capital issues with the builders and also the developer side. So we don't preferably choose the such kind of industry. We look for the industry like, to just give an example, a paint industry, which has a very fantastic track record of creating multi-bagger businesses like Asian Paint and Berger Paints. So it had a high probability of getting those success. So first we need to get the industry right. Then we need to, let's say, study the leaders of that particular industry, how they have built the business and how they have learned from their mistakes during the journey of becoming micro cap to large cap. And once we have those understandings at our fund management level, then we will meet, or let's say find a next company which is coming from small and mid cap side. And then we will try to understand from those promoters that how they are trying to take business, let's say from 100 crore, let's say the 100 crore per quarter business to 500 crore per quarter kind of business. Okay. So we also study their strategy. Okay, so how they are going to grow. And once we have sufficient evidence and we have convinced us that they are going to execute those orders and which are visible in terms of the quarterly results. So whenever we have met some management, or let's say study the business from mid cap and small cap side, we will not immediately build exposure. We will first observe for it a 1 or 2 quarters that how they are doing, and we will judge them on their speaking versus the delivery of those outcomes. So once we have sufficient evidence in terms of delivery, in terms of quarterly results, then we go and onboard those stocks. Of course, we will still can be wrong, because no one can predict the future. So that's why we build it at view. That's where our position sizing framework helps us. So we start with normally at a 3% or 4% kind of position in a particular business. And once the business starts performing, it will have like more weight coming from the particular business side. So that is my limited understanding on how the small cap to large cap journey can be little bit successful on terms of like picking the business, because it has a very low probability of becoming a large cap. So anything, Prabhat, you would like to add on this side? Yeah.
Yeah, Vijay, so as you have rightly mentioned that, we should be very strict with the filters that we apply to screen the companies, right? It's a very big universe of closer to 1,300 companies. So we should be very strict with the companies, that we are taking for, doing further deep dive into, right? So we should have absolute robust filter of seeing the past track record, how the company is shaping up with the revenue growth targets, the earnings growth, and also the debt equity level, right? Because these are the companies which are very susceptible to the change in the interest rate environment. So the small cap companies, if the interest rate goes up, they can the entire PAT can just be quickly depleted in the forthcoming years, right? So this is one of the key things that we need to look for. And again, the main focus should be on going through what the management has said in the past quarters, right? So just look at the past earning transcripts or the past annual report and see what the company has said 3 years back and how they have delivered in the last 3 years. So whether the management is sticking to its word or not. If the management is sticking to its word, it means the management is credible. Because in the small cap company, we are not betting on the business. Like, business is there for sure, but the credibility of the management is even more important, right? Because the management can manipulate the numbers in the annual report, the balance sheet items or P&L items. But if it's very difficult for a less disclosure company, for us to identify a company which has very less disclosure, to identify whether the company is making a fool out of us or not. So it's very good to keep it. It's very helpful to keep track of how the management is behaving and is it sticking to its word or not. And then if we have absolute confidence in the management, then we can go ahead and start with a very small quantity, the quantity that don't hurt even if the company goes first, and then over the time we can look to add once the company we have more we know the more about the company in the forthcoming times. I hope this helps. Thank you.
Yeah, thank you, sir. So the next question is, the funds which perform in recent times, don't perform in coming times unless they churn the portfolio, right? So how much is your churning ratio and how much portfolio has churned in the past 6 months?
Yeah. So I try to answer this question, right? So you are very rightly in saying that, the funds which perform today, unless until you don't make changes in the portfolio, they don't perform in the subsequent period, right? And the thing to do with is if we have seen this phenomena post-pandemic, that the sector rotation and the information discovery phase has become quite rapid, right? So today, let's say some news comes in the market, it's get factored in very easily. Very fast in the market, right? So whatever the company is going to do 5 years down the line, everything gets priced in today, right? So even if the company is going to deliver the earnings, the stock price doesn't move up as in the movement is there at the time of announcement, or the capacity come online, or some sort of earnings breakout happens in the stock. So the key to it is that we keep tweaking the portfolio as and when required, and as a very important parameter that we feel that whatever the profit that we are making, it's notional profit unless and until we take some profit in our accounts as well, right? So we can look to book some profits in the portfolios. And again, this sort of things will like, slightly push the churn in the portfolio, right? So I'll give an example. Before pandemic, right, when we started managing the portfolio in the year 2019-20, the churn was less than 30% for the portfolios, right? Post pandemic, the churn has slightly gone up, mainly because of the fact that we have seen this huge Ukraine crisis and the war time, right? So mainly to counter and to protect the portfolio from the downfalls, right? We have done a bit of churning in the portfolio, like, take out and build some cash position there. So all those things we have done, right, to protect against the downside. So this becomes important, because, like, if you're not doing such things, then the return will get impacted. And also second part is that, like, once the valuation level becomes excessively high for the portfolio stocks, so then you need to entirely take out of the stock from the portfolio. So I'll give an example. We are holding IRCTC, right? Whatever the target we had for that stock in our mind for the next 4 years, we achieve the target in next 1.5 year only, right? So the only option for us to take out that money, cause, like, that stock won't make any money in the subsequent years for us, right? So we are forced by the market to, like, take out the stock, not by design. We intend to hold it for 4 years, but what's the point if it's not going to make any money for us? Similarly, if you don't do anything at the time of, like, this COVID crisis, or, like, this Ukraine crisis, so the investors will face the brunt of that, right? The portfolio will get a drawdown, because at the end of the day, the portfolio is linked to the market. If the market goes down by 30%, our portfolio is also going to go down by 25 odd percent at least, right? So we are forced by the market to, like, do some changes, not very big changes, like, change some cash level, do some profit booking. And then once the economy is in a good shape, and, like, we have clear track record where the economy is heading, so then we can let the portfolio stay still and, like, compound for next 2-3 years, right? So that's how we approach the portfolio management here. I hope that helps.
Yeah, thank you, sir. So the next question is, consumption is picking up, and any segment in the retail that you're looking forward to?
Yeah. So I will take this one. So basically, there is, like you mentioned, that there is a lot of consumption uptick in the basically the domestic market. Of course, the global economies are feeling it, but the retail consumption has been sticking up very well. In fact, we had attended recently a conference in the Bombay region where we interacted with a lot of industry participants, and the electronic goods had a phenomenal growth, more than 15% year-over-year growth in the last couple of months, which was released the data just 5 or 6 days back. So we are seeing a lot of momentum, and particularly on the retail segment side, we like companies like fashion retail. So one of the company is based out of Chennai, and we interacted with the management and we studied the business model, and we liked it a lot, and we have also onboarded in one of our portfolio. So the fashion retail segment can be the one. Another segment that we like in the particularly retail side is the electronic goods, as I mentioned. So we have also met one of the company from the Bihar region, where one of our member also went and visited the particular stores, which helped us to understand the business model. And subsequently, we also met the management for multiple times, and then we onboarded the position. So valuation is very cheap versus the leaders. So these are the couple of segments in the retail side which we like a lot. Anything you would like to add, Prabhat?
Yeah, Vijay, I think it's good, right?
Yeah.
We can take the next question.
Yeah.
Thank you, sir. So the next question is regarding the paint segment. So any emerging leaders that we are looking for in that segment?
Yeah. Yeah, so I will take this one. So basically, the paints is a very robust industry. It's a 75% organized segment, and if we look at the leaders, so Asian Paints and Berger Paints command a very healthy market share in terms of volume as well as value for I think more than a decade, and they have built a very solid distribution network. But it's a growing market, so the industry itself is growing at around 12% growth. So we can expect a similar kind of growth in the at least the leaders. But we also studied the industry from a little bit different perspective, coming from the wood and coating side. So where we found a different company which had been a very solid in terms of its quality of the products, if we are looking at, and it had tie up with one of the European-based entity, where they were getting the product idea, and also they were also distributing those products in India. And right now they have also set up their own manufacturing plant in the NCR region, where they are building up and also the producing and manufacturing paints in the Indian subcontinent, and also distributing and selling in the India side. So that company we like, which is coming from the woods and coating side. So we think that it had done phenomenally well in last 4 years in terms of revenue, almost doubling its revenue and more than doubling its profit on the bottom line side. So one can also look to explore such kind of opportunities in the woods and coating side, because it had under penetration in terms of in the economy or the overall as a India, if we see. Yeah.
Yeah, thank you, sir. So the next question is regarding inflation and rising interest rate. So with interest rate rising, which favors the large caps, what is your view on it, and is it time to stick to large caps?
Yeah, Prabhu. So I'll take this question, right? So first, coming to the inflation, right? What's our view is in-house view. So mainly, what we have seen that the inflation behaves in a in a cyclical manner, actually, right? So what we have seen that in the past 2 to 3 quarters, we have seen a sudden rise in the commodity prices, right? Especially in the quarter 1 and quarter 2 of this calendar year, right? And then again, the food prices also have gone up. So that has led to the overall rise in the inflation, and again from the consumer side as well. So mainly what our view for the next 3-4 quarter is for the inflation, that stepping into the quarter 3, there will be a slightly base effect that will be kicking in, right? So the quarter 3, that will be seeing some sort of moderation in the inflation that will happen. And the quarter 4, we have a base which will be very high, right? For the if the quarter 4 of last year, this last this financial year, if we consider, right? So we have the rising commodity prices, rising food prices and all, right? And again, the rising food prices. So that will all come into play, and then basis, because of the higher base effect, will have a very softer increase in the inflation in the quarter 4 of this year, right? And we expect that the since the dollar is on upswing, right? So mainly the strength in the dollar denotes to the softer commodity prices, right? That's how I would like to put. So mainly we expect that since the Fed is on the trajectory to hike the interest rate, so the dollar will remain strong, and because of the strong dollar, the commodity prices will remain in check, right? And again, we have all those commentary coming in from the western part of the world, that the recession is going to kick in, or there is some sort of demand slowdown which is happening. So that will also impact the overall inflation environment, right? Especially for the India. So India is basically, if you will talk about the inflation, the only worry for India is currently the crude, right? And thankfully the crude is well under $80, right? And somewhere around that region, and we expect that to be remain in that region for next 3 to 4 quarters as well, right? So if we have that crude in check, then inflation is not a problem, because of the monsoon and self-sufficiency in the food production side. So the food inflation is no longer a worry for us, right? Especially it's a worry for the western part of the world, but it's not a big problem for us right now, right? And considering the huge demand environment that we have, right? So mainly we are seeing huge demand environment coming from the consumer goods side. We are seeing huge demand that's slated to come up in the next to quarter 3 and quarter 4 from the building material side, right? As Vijay has already highlighted. So all those demand environment will put us in a very good shape, where we have low inflation versus the western counterpart plus higher demand, right? So if you just put things into perspective, so there's I think in the first time in last 30-40 years, the India inflation is way lower than the western inflation, and it will subside quickly, but the western economies like US or UK will take longer time frame to cool down, and that's why we are seeing some rapid Fed rate hikes happening in those part of the world, right? So the view is that it will not be a very material event for us, and from here on, the more focus will be on the demand. So how the demand is coming up. So if the demand will be there, even with 6 to 7% kind of inflation, will be easily sailed through. The earnings will come, and then the market will rebound. Right. What was the second part of the question, Prabhu?
Sir, that's what. Can we stick to large cap because it is a rising in? scenario, interest rate scenario, and
yeah, obviously. So mainly, like, it's good to be defensive now, right? Since, like, we have a lot of macro uncertainties, right? And not just on the inflation side, but also what's the development is being like, being carried out by the OPEC countries, or China Taiwan issue, plus, like, Russia is already Russia Ukraine situation nobody can rely on, right? So it's good to be on defensive side, good to be on the consumer facing names in the large cap space, which have good demand forecast for the coming quarters. And maybe, like, once we start feeling that the situation is kind of under control, we can start to shift portfolio towards the mid cap side. And again, like, since it's a market which is, like, closely related, so any big downfall in the US market will also have an impact on the Indian market, right? So we are, from the long term perspective, medium to long term perspective, we are structurally very well placed. But a very, like, any sort of events, like negative events happening in the US market, or like any other big global market, can impact the stock market over short time frame, right? So that can't be ruled out. So it's better to be with the large cap defensive names for now, consumer oriented mostly, and then over the time frame we can shift to a slightly high beta aggressive names in the future.